Hello, I need some volume here.
Hey, Mike. How are you?
I'm doing well. How are you?
Good.
Hello, I need some volume here. Oh, I got to get rid of that.
Hey, Mike. How are you?
Hello, I need some volume here. I obviously have a few streams running here, checking on myself.
Yeah.
Um, and I actually brought some material today.
Good
Call me,
stuff.
call me crazy. We'll make that up here. We'll make this a what? How do I want to do this? All right, we'll do that. Okay. Slideshow from the beginning. All
Let me
right.
know when we're live and you're ready to
We
roll.
are.
Oh, okay. Okay. Hello. Hello.
We're live. But I was trying to do the slideshow. Why does it do that? I don't want it on a different screen. There we go.
And I won't share mine until you're ready. So just
Go ahead. You can share yours. I was going to slide mine in whenever. All right. So end show. Where's end show? Escape. Okay. Hello, everyone. October 11th. Wow. Where did 2022 go?
yeah, time flies when you're having fun. So
Uh, Greg Kuda, Westline Capital Management. I should get this off of here. Mike Wisniewski with Materials Exchange. And here we are, Tuesday, our lumber futures from the free seats. So, Greg, what do we got? Let's kick it off.
hello everybody. Hello, Mike. We'll jump right in. I think the big takeaway over the last week is uh, um, the two things that jump out at me is crude's up 22% since its 926 low off of the OPEC news, and then also the mini S&P over the last week is down 6.2%. And we can kind of get into the rationale behind these. But the one thing, obviously today, this is a chart from literally a half hour, 45 minutes ago. Lumber is actually November's traded as high as 485.20. It's 478.40 last. So if anybody's got any cash news or any news, I'm all ears because I'm kind of at a loss. Why we're continuing to see November trade at a bigger premium to actual physical cash. We're certainly not seeing it from an open interest standpoint as far as a liquidation and open interest. So it doesn't seem to be fund driven. So if anybody's got any info, please share. Um,
Well, I mean, what about the news about the railroad strike maybe percolating?
yeah, no, I mean, so the big two newsworthy events in the last couple of days. The U.S. Railroad strike is not out of the woods. I think three of the unions rejected the existing deal in place, but they said that they would not strike until Congress came back into session on November 15th. So the earliest they would give a 5-day notice thereafter if negotiations failed. So the earliest would be somewhere around 11/19 to 11/20 where they would actually strike. So again, that's definitely a possibility. And then the other news, and this was back on the 7th, Conifex announced a curtailment, a 2-week curtailment at their McKinsey sawmill that I think is going to take 20 million board feet off over the next 2 weeks here. So, again, and the third part of this, I think mills are gradually starting to rebuild order file here, selling, prompt wood in this 420, 425 to 445 area. over the last week now. Since last Wednesday, I think they've been able to build out some decent volume as far as eastern and western sawmills.
Well, and then there are technical factors.
Yeah, absolutely. Absolutely.
Today is the official higher high, higher low.
Yeah, no, and again, we'll see this. But I just wanted to show kind of what, just talking about the S&P. We're down 6%, and we're up hard today. We've bounced nicely off of lows here, where the Dow's up over 400 now. The S&P's back up over 20 after getting close to its all-time or its recent lows here. But the one thing, as we start to see Q3 earnings and then Q4 earnings, so we've got revenues per share, earnings per share, profit margins, and all along we've had the estimates versus the actuals, where the estimates are getting outpaced by the actuals. It'll be interesting to see, and you're starting to see it now with profit margins, obviously inflation, but are you going to get this rolling over where finally companies start to underperform the estimates, the analyst expectations? So I'm kind of watching that. And when it comes to the S&P, you can see we're in this downtrending channel on a monthly basis. We've shown this in the past, where 50% retracements in the 3,500 area. December futures today got down to 3,580. The recent low here is the 3,571 area. So, the expectation here is you at least drop into this 35 to 3450 area. This is your 50-month moving average. Worst case scenario, by the end of this year, we're 62% retracement back in this 3200. So I think technically we're still on that lower low, lower high scenario into the 35 to 3200 area by the end of this year, or at least that's my expectation as far as what I see technically with the S&P.
So, well, this morning I was actually chatting with some trader friends, and we were talking about the S&P. Yesterday, one of the Fed governors was discussing how big the margins are at the retail level right now. Their costs haven't gone up as much as they've been able to raise prices.
Right.
And this governor was making the case that the soft landing still could be in place if we can compress those margins back to a more historically normal level. While that sounds good for the average consumer, obviously the owner of equity in these companies probably wouldn't be too excited about that.
Yeah.
So, that it's a weird dynamic for the S&P where, okay, great, the inflation is coming out, but it's coming out at the expense of your margin.
Well, I think that's ultimately, we'll kind of see it with some of these other slide decks. At the end of the day, how does the Fed control inflation? It's through asset depreciation, and they're not picking assets here. They're basically telling you, we want all assets to lose value, and that's kind of the mindset of the Fed. And so, the big newsworthy events this week, we have CPI, PPI, CPI tomorrow, PPI on Thursday. We also have, I think on Thursday, FOMC minutes. So we'll get, a good take of what the Fed has to say here in their minutes. But you can see, this is the all telling. The red line is CPI, the blue line is wage growth, and you're just not keeping pace, where you've got to get the convergence here, where, again, this isn't a winning scenario to build valuation or to build to get appreciating equity markets when the average consumer is losing wage growth versus what they're paying at the pump, at the grocery store. Pick a commodity. Inflation is hurting people in their pocketbooks, pure and simple.
Yep, absolutely.
Yeah, so I'm sorry. We do have PPI tomorrow, CPI on Thursday, FOMC minutes tomorrow as well. So I highly encourage. These are 8:30 Eastern time, 2 o'clock tomorrow at the FOMC. So you'll see equities jump with both of these tomorrow and Thursday. Again, you look at PPI year over year, you're still looking at an 8.4 to 8.7 inflation rate. When you look at CPI year over year, you're still looking at an 8.1 to 8.3. So, again, we're looking for some kind of reining in of inflation, but the numbers so far are suggesting that inflation is being controlled right now. And then when you look at interest rates, 10-year this morning was a 392. It's about a 373 right now. So it's kind of pulled back with this rally in equities. But again, it beat a dead horse here. But when U.S. interest rate hikes, the fastest in recent history, where we still haven't got to, the expectation is to level out in this 3.25 type area. We still have some raising to go, and potentially the next one or two FOMC meetings to kind of get back into the Fed's own target rate of 3.25, 3 to 3.25. So we know that there's at least one more rate hike coming. That's ahead of us, and how does this, again, big picture? I did this today. I did an average credit score. I did a $400,000 home, 20% down. Look at your average fixed 7.68%. Now, I'm sure you can still get stuff sub 7%, depending on if you can, have a higher credit score, more money down, depending on the state variables, all that good stuff. But, best case scenario right now, you're probably in the high 6.9s to 7%. So again, all these things have to be factored in. And then, when we look at the other big kind of mover here outside of crude oil, is the US dollar. Has kind of, last week we were in that declining structure. We've had that 62% retracement now. So we'll see again, the Fed, indirectly wants a strong US dollar to rein in physical commodities here, or at least pricing. So when you look at the dollar, again, you're bumping into a major inflection point on the monthly chart right here. If you don't stop in this 115 area, then you're going to a $1.20, $1.22. And you can see here, you're at that 62%. So you're either going to stop here or you're going to go back and retest the 114, 115 highs on the dollar. Again, stronger dollar is usually negative for physical commodity prices. You look at the 5-day winners here. Well, S&P volatility is back. Obviously, lumber is probably up after today's move higher. You're up over probably 11.5%.
Lumber is we're either at the top or the bottom.
Yeah, there's no in between for lumber. The other obvious ones here with OPEC news last week, heating oil prices, crude oil prices, and again, the US dollar. So again, volatility is high. Lumber prices have had a nice bounce the last week. And then you look at the obvious ones, again, inflationary type numbers. Crude oil's up 22% in the last week. Or I'm sorry, off of the 927 low. So to say that, we've reined in inflation, and you're not going to see that reflected in the CPI, PPI numbers, where you might see a pullback in CPI, PPI when it comes to energy, but you're back up. And unless this is short-lived, I don't think the Fed's ready to make any proclamations that they've beat inflation just yet here. So when you look at the big losers, look at, you see RBOB versus heating oil. This is the seasonality play where you're driving less. So the refiners, the crack refiners, and I'm not talking about Breaking Bad. I'm talking about the crude crack here. They start to, they're starting to produce more heating oil, less RBOB. So that's kind of why you're seeing this. This is more of a seasonal play between RBOB and heating oil right now.
Makes sense.
But you look at the other losers here: foreign currencies, euro, Australian dollar, British pound. Again, here's your equities, Nasdaq. So those are your 5-day losers. And then we remember this from 1 week ago: OPEC. We're going to go back to curtailments that equaled what they did in 2020. So the net result is, again, here's the 927 low in crude. You got down to the 76.50-ish type area. You traded up to 93.50 on Friday. So again, you're up in that 22% rally off the lows. 62% puts you back in the 95 to 99 area. And we're trying to give some kind of reversal sell signal the last couple of days. But my guess is, this market holds the 9-day, holds the 44, the 50-day, kind of holds this area and then makes another run to the upside. So, the other thing with oil, and I'll kind of gloss through this, Mike, so we can get into housing and actual lumber. But, the jobs report was last Friday. And I think what's interesting is here's jobs in oil and gas extraction. So again, this is just in the United States. You can see that we're barely back to pre-COVID type levels, and you're nowhere near levels that you were at 25 to 2015, 2016. And again, less is more. Why are we going to build out infrastructure if we can get higher prices? And that's the mindset of U.S. refiners, U.S. oil companies. Less is more. We want higher prices with less. So, we've had,
This amazes me, and not to get too political here, but
yeah, no, look at the election, ding, 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 right? I mean, that's,
but we've drawn down our strategic oil reserves.
Yeah.
We need to bring them back up.
That would seem to make the most sense, but so far there's been no attempt. And I don't have the updated slide in this, but there's been no attempt to rebuild those strategic reserves as of yet. So when you look at jobs last week, the big thing is available jobs finally had a big hit. And again, this is by design. The Fed unfortunately, they want some unemployment here. They don't like the employment numbers. They're willing to sacrifice some jobs to rein in expectations and inflation. And you're starting to see that with job openings, starting to diverge now. You can see how this is correlated nicely since a year ago, and how we're starting to pull off now as far as those job openings. And so here's housing, payroll. Here's residential and commercial, construction and contractors. And you can see, again, we're struggling to get back. You did, the single family component was good, saw job creation there, but from a commercial standpoint, you weren't even back to, you wonder if this will start to, the red line will start to slacken. You'll see this get pulled into the commercial component of how our building now.
All right. You done with your, no, more housing. Perfect.
Yeah, we'll go to housing, and then you can jump in here. So this is John Burns.
Yeah, this is a good one.
Yeah, and this just shows, kind of expectations for building materials dealers inventory over the next 6 months. And so green is good. Green means that they plan on increasing inventory levels. Everything else, yellow is just maintain, and then slightly less, significantly less are orange and red. So you can see with lumber, kind of 53% of the people out there, slightly less inventory, only 12% see an increase in physical inventory. And then these are the different, building materials, but here's lumber. And then the one big one is decking and railing. That's probably not a good sign for the home renovation DIY component of demand right now.
All right, I'm gonna do a quick share of my screen here. Ooh, I got to get rid of yours. Sorry. This article I think is just fantastic, and it actually was in a podcast as well, and it's on Bloomberg, and they're just talking about how weird things are from a historical standpoint in the housing market. And really it revolves around interest rates, of course. So highly recommend checking this out. It's how weird things are getting in the housing market. But then there were a couple of slides. I don't know if this one came out of there or not, but this is a big deal. The percentage of conventional mortgage universe with greater than 25% basis point of incentive to refinance. 0. What does that mean? That just means that there are basically nobody out there that has mortgages higher than what you could refinance for today. So if you're a mortgage broker, you probably have a lot of time on your hands right now. There's nobody refinancing. When you consider that just less than a year ago, almost every mortgage out there had the opportunity to refinance into a better rate. Um, so that shows you just exactly how dramatic this change of interest rates has been. Um, Next up is affordability is deteriorating at a pace that's faster than any other pace in the last 30 years. And this is just basically it's saying that it's cheaper to rent, I believe, than it is to own a house. Um, but on top of that, apartment demand stalls out in Q3 as move-ins slow more than expected. So this is showing that less people, like there were more people moving out of apartments more than they were moving in. The only thing I could come to think of is that there are people bunking up together, sharing apartments, moving back home, whatever it means. That that I was just speaking with one of our users, Kevin Otto of Coswego Trust, and he brought this to my attention. They're real busy. Like they've got plenty of multifamily projects to take them all the way through mid next year. But he's wondering about what's beyond that. If the Fed achieves what they want, um, they're going to slow everything down, which could mean less people, less households being created. In other words, more beds in each household.
Yeah, no, and I think to add to that, Mike, Jamie Dimon, CEO of J.P. Morgan, and here's another chart that shows those mortgage applications. You're basically back to kind of the onset of the pandemic now, as far as number of mortgage applications out there, where obviously that doesn't bode well for demand because we don't have a pandemic as an excuse right now. But Jamie Dimon said, there's serious consequences here, and he foresees being in a recession over the next 6 to 9 months. And my only, counter argument to that is I agree, but there's a wide swath of people, and that probably goes back to the apartment slide, where there's a huge swath of people that have been in a recession, are already living that recession day to day, week to week, where again, that wage growth is not mimicking, the inflation that they feel every day on those core goods that they consume. Where there's a wide swath of this country already experiencing an inflation, and you're just going to, as rates continue to push higher. As you start to see job growth potentially slow down, wage growth potentially slow down, you're just going to get more and more tranches of people, actually in that recessionary mindset because they're living it day to day.
Yep.
Let's jump into lumber. So seasonality, and this kind of plays into why are we up? Well, seasonally, we should be up. I mean, you're entering into that time frame now. It's the 11th of October. So you're getting into that sweet spot, really between now and to Halloween, potentially as late into U.S. Thanksgiving, where markets seasonally bottom out. So again, this is when you traditionally get that inventory build out and expect an expectation of Q1 type needs. So seasonally, we should be bottoming out this time of the year. We might not necessarily agree with the price, but seasonally, again, this is the time that we bottom out. And when you look at November, and again, this was as of this morning. Obviously, November right now is in that 480 area. Last two November expirations were significantly higher. The previous two were significantly lower. You go back to the spike up in 2017, 500. So, what does that mean for November? Well, when you look at 575 versus 446, if you take the average of these 6 years, the average price equates to a 575. Obviously, that's being influenced by the last 2 years. if you strip out the last 2 years and just take the last 4 years, including this year, your average price is 446. So, you're within striking distance of those kind of average price levels where, going back one slide here, you could make the case that if you're just going to look at 2017 through current, your average price is somewhere around this 450 area. If you take out the last 2 years, if these are aberrations, you're kind of where you should theoretically be over the last 5 years anyway.
Now, one thing I'd like to point out here is the costs for the BC sawmills, and the legacy futures contract is a BC sawmill contract. We can pretty much agree that. The way their stumpage works is on a trailing average. So they are walking into a very expensive quarter right now as far as their fiber costs go. So they have every incentive in the world to slow down their production as much as possible, make as little wood as they possibly can.
Yeah, so I mean that's the interesting part, and again, I'd like to get clarity. Obviously, in speaking to sawmills, you could speak to 3 or 4 different BC sawmills and get 3 or 4 different answers. But stumpage costs on October 1st actually came down. So anything that moves over the scales as of November 1st has a lower stumpage cost than anything already on the ground. So 930 wood, that's anything logged prior to 10/1, has an existing stumpage cost. The new stumpage cost for anything logged after 10/1 that goes over the scales is substantially lower. And I've heard numbers anywhere as low as or as high, ranges anywhere from $40 to $75 to $90 a thousand. And so then on January 1st, you get another big reduction. So anything that crosses the scales as of January 1st, we'll see another $40 to $90 a thousand in BC. So, it could be a reason, or more so of a reason, cost of production has less to do with BC curtailments here as much as actual log deck availability, to where I think the big reason you're going to curtail if you're a BC sawmill right now probably has less to do with cost of production. Obviously for some of the smaller mills, you probably have a higher cost of production. You don't have economies of scale. You don't have the efficiency of some of the larger mills. But for the larger mills, the top 3, top 4, I truly think curtailments are more a function of getting logs to specific sawmills, and if they can't get the logs to those specific mills, that's where you're more likely to see those curtailments.
Okay, makes sense.
So we did this. So here's weekly continuation. You can see that we're trying to break out on this little sideways. This is a little
pennant.
Little bull flag right here. So you're breaking out, and you'll see it more on the. So everybody always asks me, where do you think the funds are coming out? And my expectation with November is at a minimum you'd have to get back to 520 to 560. So this 507 has actually moved down about $10 over the last week to 558. You would have to have consecutive weekly closes back above this level into this level to potentially trigger a short covering event with the funds. And so on a daily basis, 62% is 489 to 510. And you can see there's also a gap left here, 489 to 492.10 gap close versus the actual gap. The low of the gap is 489. The gap close is 92.10. So this is kind of that next area. Now that we're up here, the next target in November is going to be this 490 to 510 area. So I still think you're going to have, again, on a daily basis, you'd have to have multiple closes above the Bollinger Band high. You'd have to be up in this area. Again, there's that 560, 558 area. I'd really think you would need consecutive daily, if not consecutive weekly closes for the funds to more so just short cover than roll their position into January. And so, what does that mean from a spread standpoint? Well, the spread a week ago, we talked about how you're going to get the narrowing of the spread, and it's exceeded my expectations. How fast, how far we've come in the last week, where a week ago we were in that -10 area. 2 weeks ago, we were in that -20, -22 area. So you look at it today, this spread is traded out to 680 so far. So again, you've already moved from -23 to 680 over, and I don't think we've had really any fun rolling take place yet, which is pretty impressive to kind of be out into this 5+ area already without really seeing any signs that the funds have started their rolls. It sets up for an interesting scenario. Are these guys going to roll, or are they going to liquidate their Novembers? But that's still ahead of us. The open interest, suggests that the funds have not done anything as far as their net position yet.
Well, today we had 109 spreads so far, so
Yeah.
it could be starting.
Yeah, it could be, and you're entering into that time frame. Typically between the 12th and 15th is when you start to see the beginning stages of those fund rolls, and then it gets heavier as you get into month end. But from a basis standpoint, and the one thing I want to stress, we went from futures trading at a big discount to physical cash. Now you've seen the reverse play out now, where we'll come back to the curve here, but November a week ago was in this 49 under area. November was cash was $49 over November, and now November's gone to a premium to cash, and based upon last week's print, with November at 485, 480 last, you could make the case that this is increased now by another almost $30 a thousand, where it's, conservatively, you probably can still buy cash in the 445 area. I know West Fraser was on the market this morning at 445. And with November up at 480, if you're locked into your EFPs, then you're locked into your EFPs. But if you have the ability to liquidate November longs and go buy physical cash, then my suggestion is, if you can buy cash sub 450 right now and liquidate your Novembers in this 475 plus, you're liquidating your futures at a premium to where you can buy physical cash. You're close enough now within striking distance of needing that wood, especially on a rail car basis when that wood would ship. So the mindset is you liquidate your November futures and you go buy the physical cash. But the one thing I want to be crystal clear on from a basis standpoint, you don't do one and wait on the other. That's speculation. When you do one side of this, you immediately do the other. And typically the cash side is more illiquid. So you go buy the physical cash first. Once you get confirmation, then you liquidate the futures. And so one other thing I want to point out from a basis standpoint is that you've got a premium in futures relative to cash. So the other thing, basis always gets a bad name in an uptrending market where, well, I get locked into I'm locked into this basis. Those that should be basis trading right now are those that can put the wood on the ground and sit on it. If you're trying to basis trade something that's got a roll and you have a finite amount of time, that's speculation. That's not a basis trade. The idea of capturing basis right now is putting the wood physically on the ground and capturing an acceptable premium in futures and locking in that basis. And as that wood comes due, as that wood starts to ship, as the basis converges, then you liquidate the basis trade. But I think part of the problem when people think of basis and people getting trapped in basis trades, well, again, you have preconceived notions that one has to do, well, I want a basis trade, but only when futures goes down. Well, you could have a scenario where futures outpaces cash here, but at some point you'll get the convergence between the two. But if you can put the wood on the ground, if you're sitting on this wood, then this is where the idea of basis trading becomes something to look at, especially in seasonally, I know we're bottoming out, but you have a premium in a bear market in a bear market contract, is that sustainable? Is that justifiable to have November trading at a premium to physical cash? There better be something to back this up. That's all I'm going to say. There better be something outside of just seasonally bottoming out to justify November trading at a premium to cash.
Well, and depending on, basis can go both ways. You can either be long the future, short
Yeah,
cash.
absolutely.
So I look at this, and this may be a fantastic opportunity for you to take whatever long hedge you may have had against business on the books and roll that into a January to cover new business.
Yeah, and that's the other thing. As this spread widens out, if you're going to get paid $5 to $10 a thousand to move your longs into January, then why? Yeah, absolutely, Mike. Why wouldn't you do that? Especially if you're not taking the wood.
What if you get to $20 a thousand, right? It's even looking better.
Yeah, exactly. So open interest again. This is as of yesterday. We're hanging around in this 3,000, 2,900 area. There's been really no significant decrease in November. So if the thought process is the funds are in November and they're liquidating their position on an up move, you're going to see a big decrease in November. You won't really see a big increase in January. That's what you're looking for signs that the funds are in liquidation mode. Until that happens, then the funds are in their position and they're rolling into January. And again, when we look at the managed money component here,
bounce back to that for just a second. As a rule, the funds do not like to be in the contract when it has no limit.
Yeah. So not only do they not like to be from if you look at some of the publicly available prospectus, they're legally not allowed per their own fund rules to be in a deliverable contract, a spot market contract. So this isn't something where they legally don't want to, as far as, again, this is the fund man. I'm not saying this is this is a fund manager's role where I don't want to be in something where I can risk taking delivery or making delivery on something. Legally they can't. The one thing we know, the funds can't deliver the wood. Legally, they cannot deliver this contract for obvious reasons. So knowing that, they have to be out. Okay, technically they should be out by the 14th of November, but it's in quite a few of the funds prospectus out there that they'll tell you, this just isn't lumber. This is all physical commodities. Here's first notice day. Here's last trading day. We'll be out X amount of days. And you could see this in precious metals, in the energy markets, anything that's physically deliverable, the soft markets, everything just at ag markets outside of lumber. They'll tell you exactly when they roll their positions or are going to be out of those positions. They're going to give you that drop dead date, and they'll spell it out. Like, we're not going to be in this contract on this by this date. And that's all markets, not just lumber.
And we have 15 trading days after today. Open interest 2,100. We could make the argument that, maybe we took 100 off today. So we're somewhere around, 2,000 contracts. I would say on November 1st, we'll probably see about 500 left in there, maybe. So we're going to lose about 100 a day, theoretically.
And so the other thing I'll add is, we love lumber. Everybody that listens to this is passionate about lumber, is actively engaged in trading lumber, the analysis. There's no other side on the fund side that there's nobody there. Should I roll 100 today? Should I roll 150 today? The reality is 95% of what's going to get rolled with the funds is an algorithm where somebody is just inputting, all right, what's the average volume? What's the average open interest? What percent of this are we? We want to stay under a certain threshold. That means we need to liquidate or roll X amount per day. Okay, the computer's we're going to do 10 every hour. We're going to do 5 every hour. We're going to do 30% of this on the opening, another 70% on the close. They all have their parameters, how this stuff gets rolled, but there's nobody manually doing this. This is stuff that's all executed via a computer program. So, bear that in mind when you think of the funds. they do not spend nearly as much time as anybody else does that's actually engaged in this industry on lumber.
True. All right, let's take a look at the market structure here.
So, obviously we're seeing the industry go long. We finally had an increase in commercial shorts. And then the other big one is, again, managed money is maintaining, adding to the position here.
Yeah, so that 1,500 number is probably pretty legit.
Yeah, and so then, this is, but we talked about the Rogers fund. So here's the Rogers fund either liquidating or rolling their position from November to January when that spread traded out. We talked about the end of September, how the long fund would roll their long position from November to January. Again, this is as of October 4th, but that spread traded on the last trading day of September, traded at 20 under. There were some MOC type rolls. So again, this is my whole point, is that the long fund, we're going to roll this date. It's in their prospectus of how they do it. The short funds, we're going to roll these dates. It's in their prospectus how they would do it. Like heaven forbid you mesh these up. Why wouldn't you roll your position at 20 under? Because they're not going to waste time and energy on something that's 1% of their allocation.
Yep. The other thing I like to look at, just from a structure standpoint, is the number of traders reporting in here. You've got 13 funds holding 1,700, or 13 entities holding 1,758 contracts. 12 entities holding these long. I'd like to see these numbers go up in the producer merchant area.
Yeah.
But they're basically with the most of the open interest is in the big traders' hands right now.
And so the one thing I'll add there is if you trade lumber and you have a reportable position of 25 contracts, even if you don't have an existing 25 lot position, if you've had that in the last year, there's a high probability you're going to get an email from the CFTC asking you to update their Form 40. So the CFTC Form 40 is used to calculate these numbers. It's not a spam email. They're going to make everybody do this, especially with the new contract coming online. You're going to see significantly more people show up in these numbers, especially once this reflects the truck-based numbers, because those numbers, instead of being 25 car-sized, your requirements, I think, are going to be, and don't quote me on this, I'll double-check this, but the truck-based isn't going to be 4-to-1. So you're not going to have 100 trucks to be calculated in these reportable positions. It's going to be, I think, 20 or 25 trucks. So you can do the math where a lot more people, just by virtue of owning trucks, are going to have to fill out that Form 40, and you're going to see these numbers increase dramatically just because you're going to capture a lot more people. You're going to see a lot more of these non-reportable positions get forced into the reportable position.
All right, we're bumping up on
yeah, that was it.
And nothing else. Once again, we want to promote this new contract. From a flexibility standpoint, it is so much easier to match the number and the size of contracts, or the number of contracts to the size of your hedging needs or speculative account size. So
yeah, absolutely.
Highly encourage you to jump in. Slowly but surely, those spreads are coming together, the bid-ask spread. So it's coming around.
Yeah, and so, again, the big aha moment will be when these guys decide to go into the mini contract. Everybody else will be forced to follow them. And it's just, with each contract expiration here, we're one contract closer. So it's not a question of if, it's a question of when all this gets transferred into the new contract. So again,
right,
that will happen.
I'll wrap it up here. Technically, we've bottomed. You can make a good case the bottom is in for now. Long term, there's headwinds. There's no doubt about it. And the headwinds are not necessarily organic, if you would. The Fed's doing something to create headwinds. So my eyes and ears are on economic data, see what's coming out and see what the Fed's saying about it to get some very long-term perspective. But in the short term, I know costs are up for producers, so their incentive for to continue to make supply at lower numbers than this drops. So that I could see that this could be a bottom.
Yeah, and the only thing I'll add, Mike, is I completely agree that seasonally it makes sense. And producers, if you're listening, if you don't like these numbers, then do something about it. Continue to beat that into the ground. If you don't like these numbers, we'll say it again, demand will not be your savior. If you don't like these numbers and you want higher returns, then do something about it.
All right. Take care, everyone. We'll see you next week. All new data and new things to talk about.
Thanks, Mike. Thanks, everybody. Go Guardians.